SPHY's crushing USIG, with returns nearly 4 times higher over 5 years. That's a gap most investors completely miss. High-yield crushed investment grade here. SPHY's 18-point lead over USIG means nearly 4 times the return. SPHY's pulling ahead with 30% gains versus USIG's 20%. That's a 50% better return here. Over 5 years, SPHY delivered returns nearly 4 times faster than USIG, like watching a Formula One car lap a minivan on race day. SPHY's delivering double the bang for your buck, generating twice the return per unit of risk versus USIG. SPHY's Sharpe ratio of 0.6 beats USIG's 0.5, delivering better risk-adjusted returns even over 1 year. Think of the Sharpe ratio like mechanical leverage. SPHY delivers twice the return for every unit of volatility you're willing to endure. Maximum output, minimum effort. SPHY's 8% yield crushes USIG's 5%. That's 60% more income flowing into your pocket each year. That extra $3,000 annually, that's real money you can spend, reinvest, or just pocket every single year. SPHY's dividend yield is 60% higher, like finding way more couch change under your cushions. More income without selling anything. SPHY's 15% drawdown beats USIG's 21% drop. That's real downside protection when markets crash hard. High-yield bonds recovered in 443 days, while investment grade took 1,090 days. Nearly 3 years difference. Maximum drawdown is like a storm brewing. SPHY recovers faster with moderate damage, while USIG takes longer to rebuild after the hurricane hits. SPHY's Sortino ratio more than doubles USIG's, showing it handles downside risk far better when markets turn ugly. SPHY's positive Sortino ratio shows it managed downside risk well, while USIG struggled with losses over 5 years. SPHY's crushing it. 18 points higher returns, double the risk efficiency, better yield, and bounces back twice as fast when markets crash. The Sortino ratio is your sleep well metric. It only penalizes bad volatility, ignoring upside swings. SPHY keeps downside risks controlled for peaceful nights. USIG spreads your risk across 11,000 bonds, while SPHY concentrates in under 2,000 holdings. SPHY's focused 1950 bonds let managers pick winners. USIG's 11,000 holdings just water down returns. SPHY's concentrated approach means each position actually matters, while USIG spreads so thin, even their best picks barely register. It's focused firepower versus dilution. Both funds are dirt cheap. The 1 basis point difference between 0.04% and 0.05% won't matter here. USIG's got more firepower here with $17 billion in assets versus SPHY's $11 billion managed. When fees are this low, the difference is literally couch change. Focus on which fund performs better, not pennies that won't buy you coffee. SPHY crushes USIG across the board. Higher returns, better income, smaller losses, and way faster recovery times. USIG's massive diversification across 11,000 holdings dragged it down 18 percentage points behind SPHY over 5 years. So, which fund's right for you? SPHY for growth seekers. USIG for safety. 8% versus 5% yield. Think marathon runner versus sprinter. SPHY runs the longer race with growth potential, while USIG keeps it safe for the short haul. Match the fund to your finish line. You're responsible for your own decisions. Do your research and consult professionals before investing. If you enjoyed this bond battle, hit subscribe for weekly ETF breakdowns delivered straight to your feed.